Hey everybody, I hope everyone is doing well and had a good day. And this is going to be a brief video, not a full review, but just some thoughts I had for Thursday, September 18th, 2025. Before I start, I want to put yesterday's high, mark yesterday's high in blue as usual. That's important. But I want to start with the daily chart. Obviously, the market has been in a bull trend for a lot of bars, many bars above the moving average, trending highs and lows, open gaps down here through here. We're getting more two-sided trading over here. And you really don't even need, let me back up. As far as context, how many bars do you have to go back? To me, it's sufficient to go even right here. You can see there's a, give me 1 second. Strong bull breakout here, which developed into a tight channel. This is a breakout on an even higher time frame, the weekly chart, maybe the monthly chart. This is a bull breakout, pullback. Pullback is the start of the channel. Then we get the more two-sided behavior, the bull channel, so the second part of the trend. Because markets are fractal, you hear me talking about breakouts and second legs all the time, pretty much on every bar. And it's true on any time frame. And that's basically the structure of price movement, breakouts and second legs. And if we think about spike and channel patterns, spike and channel is a variation of breakouts, a breakout and a second leg, where the first breakout is high energy, the breakout phase, especially through here, a little more two-sided through here, but still high momentum, high energy. Market moves a far distance with shallow pullbacks in a relatively short period of time. And then the pullback begins the channel phase. We got the second leg, leg one, pullback, leg two. But the second leg is weaker than the first leg. And rather than being a breakout or a strong, tight channel, we have pullbacks. We have about a 50% pullback here. This bull leg pulled back almost maybe 90%. We had a double bottom, bull flag, trend resumption. Now we have 2 or 3 legs up, depending on how you count it. But the way I'm looking at it here, now this gets into the context going into the day. I think the channel line is something like that. It's, to me, the best fit line. It's not perfect, but it covers a lot of bars, undershoots here, overshoot here, and we're breaking above it on, this is the daily chart. What do we know about market behavior as it relates to channeling behavior? Usually, channels evolve into trading ranges. So 75% of the time, you're going to get the bear breakout of a bull channel. Only 25% of the time, you get the bull breakout of the bull channel line and an even stronger bull trend. So here we are late in the market cycle, many bars into the trend. Even if the trend started here, we're well past 30 bars into the trend. We're getting more two-sided behavior, deeper pullbacks here. And you can count 3 legs up. 1, 2, 3. Third leg breaking above the channel line. And we know that when there's a breakout of a channel line, the expectation is the market reverses within 5 bars and then tests the trend line, which is this bottom line. So this is the context going into the day. We can see up until yesterday. Yesterday is a high 1 buy signal bar. What are the expectations going into the day? There's always a couple of things. First of all, most bars are breakout bars. Most bars break out above or below the high or low of the prior bar. regardless of time frame, and that has to do with the fractal nature of price action. In fact, it doesn't matter what the time frame is. I remember reading this in the books. Al talks about the fractal nature of price action, and he says, if you take away the price axis and the time axis and you have a blank chart, it really is not possible to tell the difference between a 2-minute chart, 5-minute chart, daily chart, monthly chart. There's just no way you can tell the difference, unless in this case we're looking at the RTH chart, so there's a lot of gaps, and you can infer maybe that's what it is. But if we put that aside, even if we're looking at here's the Globex extended trading hours chart, there's just no way you can tell this is a daily chart if I take away the price and the time axis. And just a bonus, he said the only way you can actually get close to guessing what the time frame is if you drill down to maybe some extreme version, like a 10-second chart, or maybe even less, like a 3-second chart, 1-second chart, because most of the bars they're going to be sideways. They're going to be zero body, and most of the bars are going to be trading range bars. But that's obviously extreme and useless. So for practical purposes, all charts, all markets, regardless of time frame, they behave the same way. They have the same general patterns of behavior. It doesn't matter if it's a daily chart or a 5-minute chart. Why am I saying all this? Let's go back to RTH chart. And it doesn't matter. It applies to this chart as well. I just started on this one. So bull channel, bull breakout of the bull channel line, expectation, market fails to break out and reverses within about 5 bars, and then we get a test back down to the trend line. Going into the day, I said, what are the expectations? And I went off on a tangent, lost my spot. So going back to that, most bars are breakout bars, which means in general, you can pretty much expect any day is going to go above or below the prior bar's high or low. There are obviously some special cases with that. For example, back here, we had this rally and then big up, big down, bear, breakout closing in the middle of the range. So it's in the middle of the day's range, the prior day's range, after a big up, big down trading range behavior. So maybe there's an increased chance of an inside bar there because the day's opening or the close, obviously if there's no gap or a small gap going into the next day, it's opening around the middle of the prior day's range and you're expecting trading range behavior. Another example is right here. Big up, big down, big tail on the bar closing around its midpoint. Next day is a smaller bar, it's an inside bar. But for the most part, every day has a good chance of breaking out above or below the prior bar. This bar, yesterday, had a big tail and closed closer to the high. So right off the bat, going into the day, even if there's no gap, the market's opening near the high of the prior bar, or near the high of the day. That increases the chances that we're going to test the high of the prior bar because the high and low of the prior bar is a magnet. It's always a magnet. It's always support and resistance. Now we have to take into consideration the context here. Tight bull channel, but in leg 3. Bear bar closing near its low. So reasonable sell signal bar, but the context not great. Tight channel, bull trend. However, there are arguments to be made. It's a late leg in the trend. We're far above the moving average. Signal bar small. Maybe you can make 2R. And look what happened on the next bar. Yesterday broke out far below the low of the prior 2 days. That's a big breakout distance. It's a big distance from the high of 2 days ago to the low of yesterday. And that disappoints traders. It traps traders. Bulls are trapped buying too high. And the bears who did not sell, they missed out on the sell-off. They missed out on a successful trade. So what happens on a retest? Now this gets into the logic of a high one. When do you want to take a high one or a high two? There's really only two instances where you take a high one or a high two, and that's after a fresh, new, strong breakout. You get a high one buy, and you look to buy, or a high two. It's near the top of the range or at the high of the day, but the market's trending, so it's okay to buy near the high of the day because you're trading a continuation pattern. So high one, high two, high three in a bull trend, you can take those all the time. The other place you'll see high ones, low ones is in a trading range, but you only want to take those typically when they're actually below the moving average. And there's reason to believe the market's in a trading range, it's testing support, and you believe the market is going to reverse back up. So you're looking to buy in the lower third of the range, the high one or the high two, betting that you're at support, you're looking to buy because the price is going to test higher in the trading range where you can sell in the middle or upper third for a profit. Now, what is happening here? It's a high one. But is this a strong bull trend where most of the bars are above the moving average and it's pulling back to test the moving average? Like back here, this was a strong high two, or you can call it a high three, buy setup. Strong bull breakout, pull back, high one, pull back, high two, high three, or it's an implied high one, and then this is a second attempt subdivided into two. It's a high two buy setup. You're buying near the highs, but is this enough to reverse this breakout? Probably not. This needs another leg up. This looks like a minor reversal, not a major trend reversal, which means it's a continuation pattern. 80% of trend reversal attempts fail. So rather than trade against this bull breakout, look to buy the pullback and look to capture at least part of the second leg up. So high two, you're buying near the high, and that's good, or that's acceptable, because you're getting a strong bull breakout and a minor reversal, and it leads to trend resumption. But over here, selling pressure accumulating. Deep pullback there, deeper pullback here, bear micro channel. You can no longer call this a strong bull trend. And what's the leg count? Now you have 3 legs up in a channel, and you're breaking above the channel line. We already talked about the expectations of that, and the market's turning down within 4 bars. Prior bar broke far below the lows of the prior bar. Now we have a high one buy signal. But is this a strong bull trend or the bottom of a trading range? That's the question. And the answer is no. This is a breakout attempt of a bull channel line in a late leg in a trend that's gone on for many bars. Another thing I want to talk about is how to actually use the moving average. How do you use the moving average as an indicator that's useful or as a tool? I remember when I started studying Al Brooks, I turned my bars were green and red. I turned them white and black like him. I put the 20 EMA on the chart, and I didn't even know why. I didn't know why it was there. Now I have an understanding of why I actually like to use the moving average. It's not necessary. Some traders I know don't actually even use a moving average, but to me it's helpful. The reason for that is it gives me an idea. Well, it objectively plots the closes of the past 20 bars. That gives you an average of the past 20 bars, and it gives you an idea of what the general fair price seems to be. Or I should say the moving average is one measure of average. And average, you can call it fair, you can call it value. And it's the bar's relationship to that line that really matters. And think about the logic back here before I get into the context going into the day. What's happening here? Lots of bars above the moving average, tight bull channel, first reversal, first significant trendline break, probably going to be minor and lead to a trading range. It's also the first close below the moving average in many bars. If the bulls, think logically, if the bulls have been buying above the moving average, above the average price for all these bars, what's going to happen when they finally get the opportunity to buy below the average price? They're going to take it. The only way a bear can justify selling here is if there's sustained momentum, because they're going against a tight channel that's probably going to get a second leg up, and this is probably going to evolve into a trading range, worst case, for the bulls. So it's probably not going to reverse into a strong bear trend. In a sell down here, you're selling below the average price near support. So it's really hard to justify selling down here. And this kind of scenario, strong trend, many bars above the EMA, this kind of bar below the EMA for the first time in many bars is going to attract a lot of buying. Gap up, strong bull trend bar. Now, what about the relationship to the moving average up here? Now, I'm going to say it again. It's a bull channel, the weaker part of the trend, more likely to evolve into a trading range. We have 3 legs up and a trend line break of the last leg. This is a tight bull channel. This broke the trend line. I'll draw that here. There's a bull trend line, and this bar broke significantly below it. This is unsustainable buying. And the bulls are exhausted. It's been 3 legs up, and the bulls are looking to take profits, and it's more likely the market's going to correct for a couple of legs sideways to down after 3 pushes up in a channel. Again, most of the time, channels evolve into trading ranges. They don't usually break out into even stronger trends. So what's the problem with the high 1 buy signal bar here? The question that we always have to ask ourselves as traders, as price action traders, and if you're trading breakouts, you have to ask yourself, are there going to be more buyers or sellers above the prior bar? Are there going to be more buyers or sellers below the prior bar? And for the high 1 here, the reality is that there's probably more sellers above yesterday's high than buyers. So this is a low probability, weak, high 1 stop order buy. Now in saying that, I'm suggesting that the expectation is that the upside is limited and the bulls who buy are going to be disappointed by their entry bar. So I'm expecting today to be a trading range day, trading range bar. And if the bears are lucky, limit order bear selling above, maybe it's a strong reversal bar or bear trend bar. Why is it a weak high 1 stop order buy? Because of the context. I talked about that earlier. This is not occurring in the early phases of a breakout in a strong new trend, and this is not at the bottom of a trading range. So this is a high 1 in the late phases of a channel, leg 3, breaking above the channel line. The expectation is the market's going to reverse within 5 bars and test down to the trend line. The bar is also fairly big, and if you're buying above a fairly big bar, then your risk is big. Even if you go for 1 times the risk of the bar, you buy at the high of the bar, stop below, 1 times your risk is all the way up here. Do the bulls look like they have the momentum to do that in 1 or 2 bars? I don't know. Probably not. Because it's a late leg, the bulls are exhausted. And this gets into what I was saying down here. The only way a bull can justify buying up here is if there's sustained momentum. This is purely a momentum trade. And that gets into why we use the moving average. A bull is not buying here because it's great value. The bulls were buying here because it was great value. It's below the moving average after it had just been above for many, many bars in a tight channel. First reversal, probably minor. bulls are buying value here because it's lower than the average price. But up here, the only way you can justify buying is that your premise is there's momentum, the market's going up, because you're far above the average price. This is not a value trade. Can you justify buying the high one above yesterday's high by saying there's momentum? Probably not, because there's momentum through here with some pauses, but then you have a bull breakout bar, bad follow through, trading range bar, much smaller bar here, warnings that the momentum is waning. Then you get a bear bar closing near its low, and then this bar goes far below the low of the prior bar. So it's really hard to say. It's hard to objectively say this is strong bull momentum over the past couple of bars. So what happens here usually is you have bulls who bought here, trapped on the bear reversal. They're probably disappointed with the size of the bear breakout. And they're keeping in mind anyway that they're buying a late leg and a breakout of a bull channel. They know they're doing something that's low probability. And the only reason they're taking the trade is because it's a momentum trade. So as soon as there's no momentum, the bulls can bail out of the trade. And the bears are going to start selling. The bears are selling value. They're also selling the context. 3 legs up, channel probably going to evolve into a trading range with the minimum target probably being the bull trend line here. So that's why the expectation going into the day is that there are probably sellers above yesterday's high. And the day structure as a whole, it's probably not going to be a big, strong bull trend bar. I think the stop order bulls who buy above yesterday's high on the daily chart are going to be disappointed with their entry bar. And I'm really more expecting a trading range bar, trading range day. So rather than go bar by bar, I just wanted to talk about the chart as a whole as it relates to everything I just said. There's a gap up going into the day, and the gap was 26 points. The recent average daily range, I don't have it off the top of my head, it's about 45 points though. So if the size of the gap was 26 points, and let's look at some average bars. Maybe this is an average bar, 48 points, about 40 points, 40 points. That's above average, maybe that, 37 points. So about 40 points looks like it's the average. Now, what did we say the gap up was? 26 points. So that's more than half a recent average daily range. What does that mean? It means the upside of the day is probably limited. If we just took a measured move of the gap, this is yesterday's high. If the gap is a little bigger than half, assuming that was accurate, and I'm going to say close is close enough for this. If the gap is about half the recent average daily range, then the upside is probably limited to the same size as the gap. Maybe we get a measured move up of the gap, and the 26-point gap gets to about 52 points. Seems to be a little bigger than the average daily range. That's why you take into consideration the size of the gap and all the context I talked about on the daily chart, why the upside is probably limited. That makes sense. The upside here is probably limited to maybe here at best. And we can see what happened. So this is where I want to just talk about what happened through here. Trading range open, which happens 80% of the time. And then look at 6, 7, and 8. Very strong bull breakout. And this is where it gets tricky. It's kind of deceiving. There's no doubt about it that 6, 7, and 8 are very strong. It's a very strong 3-bar micro channel for the bulls. Bars are uniform in size, closing on their highs, very little overlap between the bars here, with the exception of 6. Micro gap, very small tails above and below. This is as tick gap here. This is about as strong a signal as you can get for a 3-bar micro channel. The problem is that the signal bar is not everything. And a setup is comprised of a signal bar and also a collection of bars to the left. So what's the context? What kind of setting is this happening in? 6, 7, and 8, it's probably going to get a second leg. It's probably going at least a little bit higher. But if we keep in mind the context on the higher time frame, the daily chart, then we know the upside is probably limited. There's probably more sellers above yesterday's high than buyers. So it's a great looking breakout so far, but low probability event. If you're betting on a strong bull trend continuing here, you're betting on a 25% probability, generally speaking, about the relationship between a breakout of a channel line and how 75% of the time you get the bear breakout of the bull channel. So very strong breakout, 6, 7, and 8, but that's only the signal bar. And it's probably okay to buy, but you have to know that this is just like I was saying on the daily chart. You're buying momentum here. And bar 9 is not momentum. It's a warning that maybe the upside here is limited. And if you're buying momentum this far above the moving average, when you start to get signs of waning momentum, you need to be quick to exit. So small bar here, breakout bar, but then doji overlap, much smaller bar, 12. So we're probably going to pull back fairly soon here. And the pullback can be deep. And again, as strong as this breakout looks, the problem is the context on the higher time frame. Now, this was a strong rally, and that is probably going to limit the downside. It's probably not going to be a strong bear reversal bar on the daily chart, strong bear trend day, after this much buying on the open. It's probably not going to happen. But we have to remember that every rally, the market's always testing prices. And it's always probing up and down, looking for the fair price. It's always moving. It never rests, and it never goes sideways. And what's happening is the market is going higher because we need to go higher to find traders willing to sell. There are traders willing to buy, but if you're putting a limit order below the bar, you're not getting filled, and you're getting trapped out of this rally. And until we get to a price where the bulls want to take profits and the bears want to start selling, we have to keep going higher and higher. So getting some weaker bars, 9 through 12 for the bulls here, some more overlap. Smaller bar 12, losing momentum far above the EMA. Remember, the bulls are buying momentum. So when they start losing momentum, they need to be really quick to exit. This is enough of a warning that we may start to pull back here. Bull breakout bar, doji, breakout bar, doji, smaller bar 12, 9. Bear bar closing on its low, 14. This is a bar that it's really not wise to be buying because the reversal and follow through is probably going to get a second leg down. And because the bulls were buying momentum, when they lose momentum, they may wait for a deeper pullback before they start to look to buy again. And again, the bigger picture, the context on the higher time frame for the expectation for the day is that this is not going to be a strong bull trend day. And this might be the start of a climactic reversal on a trading range day, because the odds were there would be sellers above yesterday's high. And that's this blue line. Remember, trading range on the open, trading ranges are magnets. They act as a magnet. It's an area of agreement, and then price went higher, trying to break out above the trading range and form a bull trend, or getting a strong reversal and follow through 13, 14. The bears would get this micro channel that really damaged the bull breakout. Deeper than a 50% pullback from here. Maybe it's about a 50% pullback from here. But either way, much deeper than the bulls want to see. Strong bull trends don't get 6 or 7 bar bear micro channels and 50% pullbacks. So we know at this point the market's either in a more broad bull channel or a trading range. And now we have the problem of big up, big down. Both sides need a second leg. The bulls, the rally, trapped traders down here. The reality is that there are trapped traders. Trading range open, they're fading above bar 2, fading the breakout, they get trapped on 7, follow through 8, they probably panic out, but this creates support down here. But then we get the bear micro channel, and the traders who bought below 12, buying below a strong bull bar and a strong micro channel, they get trapped 14. I talked about why it's not ideal to be buying here, and if you did buy 12, probably wise to exit below 14. It's like a default exit here below 14. Just get out and look to buy lower. And the bears get followed through 15. This needs a second leg. And what happens? Both sides need a second leg. Trap traders above, trap traders below. Resistance, bar 12 low, this area, probably going to act as resistance. This area, the 2 high, will probably be support. And this often leads to a triangle when you get big up, big down, because both sides need a second leg. There's trap traders below, trap traders above. So the market gets near support, turns up, gets near resistance, turns down, testing that support again, but now it's a second leg. Now what's happening here? Ideally, if you're a bear, you want the market to go lower. Swing trading bears want a lower high major trend reversal. Unsustainable bull trend, very tight channel. It's a breakout on this time frame. But then a significant trendline break. And the ingredients for a major trend reversal, for the bear case, you have a bull trend, a trendline break, breaks a significant trend line, and then a retest of the old trend's extreme, and then you get trend resumption. And the bear's hoping we get to a new low of the day, and we get a major reversal from a bull trend into a bear trend. The problem with that, the reality, is that most of the time, major trend reversal setups develop into trading ranges. So you get the major trend reversal 40% of the time, and you get a trading range 60% of the time. So most of the time, this is going to go sideways and evolve into a trading range, not an opposite trend. Bear breakout, breaking the trend line. Now we're testing the highs with 2 legs. 122 strong enough bar for a second leg. It got it, but you have trap traders above, trap traders who bought 22, disappointed with their follow through. The trapped traders above contribute to the selling that leads to the second leg down. Bears want trend resumption. They want this to be a bear trend. But instead, they're getting a climactic bar, 29, weak follow through 30. We're breaking below the prior leg, 20, but not closing below. Micro double bottom, probably going to pull back soon. This might need its own second leg, but the downside might be limited because we're also testing this support from earlier. This bull breakout trapped traders earlier. Now that we have a possible second leg trap, and this might be trapping bears into selling too low, selling at support. And the bull breakout probably needs some kind of a second leg as well. Now this is another example of a low 1. Remember I said about high 1s. You can buy a high 1 in a strong bull trend, high 1 bottom of a trading range. But if you have a high 1 late in a channel or at the top of a trading range, you want to fade it. The same thing is true with a low 1. This is a low 1 short. Bear breakout, pullback, continuation, triggering the low 1 below 31. But this is more of a limit order fade setup. It's a low 1 that you actually want to buy because the signal bar is bad. It's a buy signal bar, bull breakout bar. It's a second leg trap or a possible second leg trap, but it's 2 legs down to support in a trading range. That's why the low 1 here is more of a buy setup. Low probability sell, which means high probability buy. And you can see the reaction. Bulls getting their second leg, 1, complex 2-legged pullback, 2. It's a high 2 on a higher time frame. But remember, this is about a 50% pullback of the rally. So now the upside might be limited, and this damaged the bull trend argument. it's a trading range at this point. So the bulls might have a hard time getting much past this trap price, the 12 low, maybe the 13 low, maybe the 12 close, somewhere in this area. I'm expecting resistance and a very, really decent time control and price control by the bulls. But this is another example where the signal or the behavior looks strong, but the context is really not all that good. Spike and tight channel to break out on this time frame with very little selling pressure. But look at the context. We're only just breaking out above 23 on bar 39. We're testing the 12 low. If I'm buying here, I really want to see the market break strongly above what I'm expecting resistance to be, the 12 low. If you're buying here, you're buying momentum. You're not buying value. And the problem with buying here is it's possibly a lower high double top with 23. Lower high from here. Did the bulls get a strong breakout above the resistance on bar 40? No. Second attempt 42, but again, now we're getting that high one, but at the top of a trading range. And if the bulls are buying here, they're buying momentum, but now we're going sideways for 3 or 4 bars. So it's hard to justify buying, and that can lead to a reversal. So probably sellers above 41, sellers above 42, sell the close 42. The upside is limited, and then you get a second entry short, reasonable stop order sell below 43. And it's a trading range. And what happens? We come back down and test support. What support? That bar 2 breakout point high, that's one level of support. It's also maybe the bad signal bar 30, got a quick test and then rallied away from it, but support and resistance are more of a zone than one horizontal line. So that's why I have 2 horizontal lines here. This is sort of how I see the buy zone. It's not just this level or just this level. It's somewhere in here. I'm expecting sell-offs to hesitate and then possibly reverse back up because it's a trading range. So kind of the opposite happening here. Bear micro channel, but bad context, forcing me to sell low in the range. And when you start losing momentum, you start getting 4 bars going sideways. The reality is that the bears are going to give up and look to sell higher, and the bulls are going to start to get aggressive, and it leads to another reversal back up. So this is another low one, but bad context. Low one short, bear micro channel, pull back. We try to resume below bar 53, but there's probably more buyers below 53. It's a low one at support, low in a trading range. That's a fade. It's better to buy there. Same thing happening here. You can call it a low 2, but probably buyers below. This one a little different, maybe buyers at a distance below. The bar is small. We could easily test lower in this range, the tight trading range. So traders might buy at a distance below the bar. But either way, the downside here, probably limited. And the same thing happens with a low 3. Big bear bar 63, but still not breaking below all the bars to the left, not breaking below the bar 2 high breakout point, and you get the strong reversal up. I said I wasn't going to do a bar by bar, and I'm just about out of time here. So that's going to do it for the end of day review for today. So thanks everybody for watching and listening, and I hope everyone has a great night.